You're listening to the Wealth Mindset Show, where Hixon Zuercher Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey. Welcome to the Wealth Mindset Show, where our Hixon Zuercher team will have conversations on managing wealth, navigating retirement, and making smart decisions for a secure, meaningful future. I'm Austin Wilson, Director of Investments at Hixon Zuercher Capital Management.
And I'm Josh Robb, Director of Wealth Management at Hixon Zuercher Capital Management. And today we're joined by our CEO, Tony Hixon, and our other wealth advisor, Chase Rose.
The other guy.
One of the other advisors. And we're going to be talking about market corrections, what's going on, what you should be doing. And we're going to jump into it. He came prepared. He's got numbers.
I got numbers. So, as you may have heard on the news, because lots of people listen to the news, everyone talks about the markets. That's probably what you guys talk about when you hang out with your friends. That's what I do anyway. The market's down a little bit this year. And the market is down. As of the time of recording, the S&P is down about 8% from its recent all-time highs. We were down over 10, and that's what prompted this episode, because 10% marks what we call a correction. So anything when you on a closing basis anyway, close more than 10% from an all-time high, boom, you're in a correction all of a sudden, and we need to talk about what that means going forward and where we are today. Tech stocks are actually feeling the brunt of this. They're down a little bit worse. They're down 12% now, and they were down as much as 14%. So tech stocks a little bit worse off than the overall market. Other areas of the market not as impacted, some more of the defensive plays, but the tech side of things, the more that have had the great run over the last couple of years, really down sharply right now. And ironically, bonds have really underperformed for many years now, and they are, or for a couple of years anyway, of great stock performance, while bonds are actually decently outperforming stocks this year, and that's a unique situation as well. So the question you may ask is, why are we in a market correction? And I'm going to give you two words that are going to answer that. Tariffs. U.S. tariffs.
There's your second word.
That's U.S. tariffs.
You started with one word.
Yeah, one word turned into two, but U.S. tariffs. And these tariffs have really come down from the White House as a response to what they call unfair trade practices around the world. And we're going to talk about tariffs a little bit more, but it's really the uncertainty that these tariffs bring that's causing uncertainty in the markets, and the markets hate uncertainty. Because when there's uncertainty, there's a lot of unknowns that can happen one way or another, and they like to see a steady, clear path ahead, and we don't necessarily have that. So that is where we are today. But any other thoughts on kind of what's going on and that you guys are seeing in the markets right now, the economy? This could be driving this.
But one thing I wanted to point out is, obviously the tariffs are a big play, like you talked about. But we did have two really strong years in the stock market, and we know that at times when that happens, if earnings don't keep up, you can get overpriced or overvalued stocks. And sometimes an adjustment like this helps bring things back into line. Is that some of what could have been happening too?
Totally. I actually went into this year not knowing this was going to happen, but thinking, hey, we've had 2 years of 25% returns for the S&P 500. That's almost unprecedented for that level of returns a couple years in a row. Valuations by any measure were lofty, especially given the fact that interest rates were much higher than they were a couple years ago. So you go into this and you say, it would not surprise me. I told myself this going into 2025, it wouldn't surprise me if we had a 10% correction at some point this year. Like, I just feel like we need one because of where valuations are and how much the market's run up. Well, at that point, when the market valuations are elevated, like you just mentioned, I think the market's kind of looking for a reason to pull back, and it doesn't take much.
They need an excuse.
And it's interesting because tariffs, as we're seeing them today, they shouldn't be a surprise, right? Because we were listening to President Trump in his campaigning for the last year talk about how he was going to put tariffs on things. So this really shouldn't be that much of a surprise, yet somehow the markets are spooked. I think the markets are using this as an excuse to right-set expectations and get valuations back down to more reasonable levels. But you did bring it up, corrections, they're fairly common, actually, right?
Every year.
Let's talk about some statistics around market corrections while we're on the topic here. Since World War II, essentially, there have been almost 50, so about 47 10% corrections. That actually works out to about one every year or so of a 10% correction. And the average drawdown in a year is actually 14% anyway, going back all the way back then. So if you think about what's happening now, this is totally normal it just doesn't feel normal because we haven't had this in a couple years.
Mm-hmm.
And I think that's what's causing some concerns right now.
Yes. So you're right in that normal is relative as well, because we had 2 pretty low volatile years of upward movement with minimal drawdowns. And now we're experiencing what historically is a normal movement in the market. Feels different because you just haven't had one in a little while.
Yeah, that's a great point you also made, though, about the low volatility the last 2 years. Yeah, the markets were performing very well. But even when you look at the VIX itself is up over 50% year to date. So not only is the market...
the VIX is a tracker of volatility.
Exactly.
Right.
Exactly. So, that's a telltale sign of, Austin, you mentioned the market looking for a reason to pull back. And the fact that we're getting this tariff information live, I mean, we're not waiting for some presentation or things like that. We're getting live feed data, and the markets are reacting very quickly, which is another recipe in there as well.
So you mentioned the VIX. I think that's a super interesting kind of fear risk indicator for the market. And yeah, you mentioned it's up over 50% year to date on an absolute basis. But the interesting thing is that the VIX is only at historical long-term average levels right now. So we're like at it's like 20 or something like that for the VIX. But those typically during bear markets, which is a drop of 20% or more, the VIX is much, much, much higher than we are right now. But we're actually just at average levels of volatility. It's just been so low for so long that I think investors were caught sitting on their hands, right? So they're like, oh, it's just going to ride and go up and to the right forever, and it's going to be really smooth. That's not stocks, people. Stocks do have pullbacks. Pullbacks are healthy, actually, and they prevent things from getting overdone. What this is actually causing, I think, is a little bit of panic in terms of investors that just hadn't had volatility in a while. And if you look at like surveys, so like the AAII bullish bearish indicator surveys and stuff like that, all these sentiment indicators for markets, they are just tanked. They're absolutely nowhere. And actually, historically speaking, when sentiment gets that bad about stocks, it's usually a pretty good time to get optimistic about stocks in terms of their forward performance.
So it sounds like you guys are saying that the main reason for the downward trend in volatility is because of tariffs. So let's discuss, what are they? Yeah. If this is the major concern, what is a tariff and why all the concerns about it?
Yeah, well, coming off of the inflation that we experienced in 2022, that was not fun for anyone, right? And in response to that, the Federal Open Market Committee started raising interest rates to levels that we haven't seen in 20 years at that point. And while they did start pulling back on those rates the last couple of years, they have since paused. And so that's one of the first meeting the Fed had post-election back in November. They communicated to the world that they're going to stop cutting rates because the economic data was looking really well. Unemployment was just fine. It was well within the realm of where they want it. But also the tariff they were proposed at that point in time, but the potential of those tariffs being inflationary is there, and therefore they pulled back their rate cut estimates. In turn, rates shot up, bond prices were impacted because of that, and also forward estimates for profitability. So we saw the start of this pullback happen at the end of last year. I think we had a little bit of positive performance at the beginning of January, but it's really continued since then.
Yeah, I think that what's interesting when you think about tariffs, so tariffs are essentially, so if a foreign country is shipping their goods, they're exporting them to the U.S. The U.S. is buying them. There are multiple ways you can do this. You can charge a tariff, which is an additional tax on top of those goods when they come to the U.S. That is one way that you can try and protect domestic production, try and control supply and demand and these sort of things. And other countries around the world, they do this on U.S. goods too, right? And that's one of the reasons that President Trump is instilling a lot of this, is he's saying, hey, Canada, they have 250% tariffs on our dairy goods going into Canada. Why wouldn't we have a 250% tariff on their dairy goods coming here? That's what's called reciprocal tariffs, which is a common word that's being tossed around in this whole discussion. So tariffs are added costs on those imported goods that we're placing on based on where they're coming from on top of the cost. It goes a couple different ways there, but those are essentially going to be costs that have to be absorbed somewhere. Now, there's a lot of different philosophies on who absorbs the cost, right? Because from import all the way to the consumer, there's a lot of people in the middle, a lot of companies in the middle, from distributors to suppliers to retailers, yada, yada, yada. Well, a lot of those middlemen are going to have to take they're going to have some profitability hit, of course. But a lot of prices, they may actually end up having some prices passed along to consumers. But at the end of the day, one thing that we talk about here in the office is the consumer still has the same bucket of money, right?
Mhm.
So they're still spending the same paycheck that they have. So they're actually going to be forced, if prices do go up on some of these goods, their overall spending is not going to change. They're just going to have to pick and choose what they're going to be spending on. And maybe they're going to choose a domestic good over an imported good or something like that. So one thing this is actually doing is we've had exceptionally low tariffs for coming down from like the 1930s all the way to today. They've been down to the right overall. Very low tariffs for a long, long time, pretty much free trade around the world. One thing this is doing is kind of getting back to the way things were prior to the last recent history. And prior to recent history, tariffs were very common. There wasn't free trade, but it was also, you pretty much ate what you made, right? So the countries that made their own food ate their own food, and we've gotten away from that with a very globalized trade system. So I think we're getting a little bit back to that. So yes, we think this absolutely could have some impact on consumer prices, but those prices are going to be a lot of the imported prices that are going to be increased. So to the way that supply comes online in the U.S. on U.S. manufactured goods, maybe consumers will actually do okay, and they're just going to have to pick and choose what they're buying. So I might have to cut back on my Perrier. That's imported from France, and watch out, there's going to be a tariff on there, but I might get my great value sparkling water and do just fine.
Yeah, so it's causing like a different type of inflation. Typically the definition of inflation is too much money chasing too few goods, and that's what we had in COVID, right?
Sure.
So the government, put $5 trillion of stimulus money to work in the economy. We were all at home in front of our computers shopping on Amazon. Well, the issue was that there was nobody in the factory working and producing the widgets, and supply chains were affected, ports were clogged, and that was way too much money, and the goods just weren't there. So inflation spiked at over 9% in June or July of 2022.
Correct.
This is a different form of inflation in the fact that there is no stimulus money. We don't have extra to spend, but prices will likely increase. So to your point, Austin, it's going to be a consumer discretionary issue.
Absolutely.
Where I may have to not buy that item. I'll have to buy this one just because the price of that one is higher than the domestic good, which is really what this presidency is trying to do is make America great again, right? It's the whole movement to insource and onshore manufacturing and goods to the USA, so to drive prices down.
The problem with that is if we're not making it, there's not a quick turnaround to start making it.
Correct.
So there will be potentially a disruption in the interim. And I think during his State of the Union, he mentioned this kind of discomfort zone of there'll be a time period of
an adjustment period.
Adjustment, yes, a rebalance. But you can't turn manufacturing on overnight if you don't have the facilities.
Yeah, you can't build a steel mill.
It
take 2 years to build that.
That's going to be the biggest issue, because for how many generations has the U.S. gone away from manufacturing here and become more the innovator in creation, but then outsourcing the actual production?
True.
And so there will be or potentially be a shift. And I think COVID brought that to the forefront in that when supply chains get disrupted, you do want to be able to make things a little more local so that you can continue to have at least the essential things. So I know there's been a push, especially for chips and the components that are very vital for a lot of our stuff, to at least have some manufacturing closer to home to have that supply chain issue solved.
I think that specifically when it comes to staples like the foods that you eat and the toilet products and the paper and all that stuff that you just need and you consume all the time.
Consumer staples.
Consumer staple products, you need to have that domestically produced, but majority-wise, because then you're not tied. You can survive and limp along no matter what happens, but then you're not tied to some trade issue causing you not to be able to get your products. So I think you're right. I think coming out of COVID, we saw a lot of weaknesses in our globally tied supply chain, and some stuff has already been improved since then.
Yeah.
Not to the point where we could completely go cold turkey and not import anything. We still shop on Amazon and buy things made in China all the time. Half the stuff I'm looking at is made in China. But that is something that I think has improved a little bit over time here. So that's certainly contributed to market volatility that we've seen so far, just as a brief history of the tariffs that we've seen. So like I said, long-term history says tariffs have come down in the last 100 years or so. But around 1930, there was the Smoot-Hawley Tariff Act. And that was one act that raised U.S. import duties to historically high levels, much higher than they are even now and going to be probably here soon. But that actually hurt things and caused the Great Depression to be even worse because it really stifled the global trade that was already starting to grow at that point. And that was a contributor to dragging that out a lot longer than it actually had to be. The next big tariff discussion that was had was really in the early 2000s, so about 20 years ago. And in 2002, the U.S. imposed tariffs on steel imports. Does that ring any bells? Because that seems to be something we're talking about a lot right now. And that's, again, aimed at protecting domestic producers of steel. It led to retaliatory measures and job losses in other sectors. And that's one of the fears of what's going on when you're starting to have a steel tariff war with potentially Canada. Canada produces a ton of the steel that we use, and their retaliatory tariffs could have an impact on us and actually outside of even the steel market. Mm-hmm. And then most recently, in Trump's first presidency, we had a trade war with China, where we were in his 2018, 2019, we're talking about billions of dollars worth of goods. This ultimately disrupted supply chains overall, and there was a lot of negotiation back and forth with phase one trade deal, which kind of got enacted, but China didn't hold up their end of the bargain, which is, I think, one reason Trump's still kind of mad at them. Mm-hmm. And then he was working on phase two as he was exiting office after COVID. COVID kind of threw a wrench in all those discussions anyway. But that's kind of the history of the U.S. tariffs. So 100 years ago, tariffs were normal and they were very high. And then they've just pretty much come down slowly over time to almost nothing for the last 40 years.
Mm-hmm.
Have you ever thought about how your financial choices reflect what truly matters to you? At Hixon Zuercher Capital Management, we believe that integrating your values and dreams with your financial future is key to achieving peace of mind and confidence. When you engage in deep conversations with us, you'll start to see how your money can support the things that matter most in your life. Our holistic approach means that your financial plan is more than just numbers. It's a personalized blueprint that evolves with you. You'll have a dedicated team of professionals tailored to your unique needs, all focused on crafting an investment portfolio designed to help you achieve your specific goals. Plus, our on-staff retirement life coach offers guidance to empower you toward a fulfilling retirement that goes beyond just financial security. Ready to transform your relationship with money? Join us at hzcapital.com and let's embark on this journey together. Now, back to the show.
Here's a great question that some of our listeners might not be paying attention to. Oftentimes, as American citizens, we look at the stock market and we look at something like the S&P 500, the NASDAQ, the Dow Jones, all those indexes. But I think tariffs impact markets well outside of the U.S. as well. With the U.S. being primarily a consumer-driven economy, we are importing so many goods that other countries are relying on for their GDP measurements. So how can the tariff conversation not only impact U.S. stocks, but how does that impact the global market as well?
I mean, it certainly impacts global markets. What's interesting, though, is that this current tariff-driven sell-off, U.S. stocks have suffered. International stocks have outperformed and outperformed pretty substantially, which is super interesting. And it's not what we would have anticipated because we're saying, hey, if there's going to be a bunch of extra costs on those imports from you, we would imagine that would be bad for you. Mm-hmm. But actually, because of years and years and years of underperformance in these areas of the market, they were so beat down areas of the market that, first of all, valuations were very favorable.
Sure.
So they've actually outperformed as of late. But secondly, it was like, if there was any spark of what it took to make people around the world, investors around the world, not optimistic about the U.S., making the U.S., if they think the U.S. looks bad because of our tariff policies,
sure,
they're going to be more apt to put the capital that they were putting in U.S. stocks and putting it in international stocks instead. And that's kind of seen a shift that we've seen recently there. This does mean, fundamentally, some of these areas would be at risk. China's our biggest trading partner, right?
Sure.
So we are not anywhere level in terms of a playing field in terms of how much we're importing versus how much they're importing or vice versa.
Yeah.
However, they've actually fared better from a market standpoint than we have this year.
Yeah.
Other areas of this in the past have shown mixed results as well.
Sure.
It just depends. I think every trade war is very different, especially this seems to be A, targeted to certain areas and certain products, but B, also not targeted because it's kind of an overall look at our trade policies as a country in general. So it's both narrow and specific, where I think in the past, it's been one or the other.
Sure. And another point, I think if you truly believe in the efficient market hypothesis, you saw the sell-off that happened in international stocks post-election. Yeah. Obviously, with Trump being, winning the election back in November, at that point, people were confident that tariffs were going to be a real thing in the future, right? And we saw an international stock sell-off at the end of last year. And what we're seeing at the beginning of this year, much of the discussion is between not your international developed countries like in Europe, but more so with Canada, with Mexico, and with China as well. That's primarily been the focus of the tariff discussion up to this point. I feel like Europe's kind of taken a backseat to that discussion yet. Maybe you have more thoughts on that. I'm not sure. But I feel like once those plans start coming to light, we might see a little more volatility, but that we certainly don't know at this point.
Yeah, one thing that's interesting when you're looking at election results to today, year to date and election, very different results. So the election happened last November. U.S. stocks ripped for a couple months after that, and international stocks tanked, right?
Mm-hmm.
Since the beginning of the year, however, U.S. stocks have tanked and international stocks have ripped.
Yep.
And actually, if you look net, they're both probably about where they were prior.
Yeah.
It just happened in two very distinct buckets of how that happened. What I think that's telling us is that the markets themselves don't necessarily know how this is going to play out, right?
Yeah.
They're constantly reacting to headlines over time. And when markets are reacting to headlines, that is not necessarily, as we know how specifically President Trump negotiates, that's not the final deal. That's not what we're going to end up with. That's just kind of a bargaining token that he uses. Yeah. And I think that's what's happening in the market.
Sure. Yeah.
I think too, it's important to get it in our minds that the Trump 1.0, right, the phase one, Biden didn't roll them back.
Yeah, true.
They didn't. They stayed. So this is like phase two. It's not like we're starting from scratch.
Right.
We're adding to. So the fact that it's been this big of a deal is a little bit head scratching to me. It's not
at least
like
for China.
Yeah, all kinds of crazy stuff. So we didn't roll them back to zero. They're just a continuation of what he started on his first presidency. But I would love to hear Josh as our director of wealth.
What do you do, right?
What do you do? Well, we sit across the table from clients who are experiencing, their 401ks decreasing by 10+%. How do you help them stay calm in these types of volatile markets?
Yep, and it comes back to really that having a plan. So you know what your objective is long term. And when you have a plan, it makes it easier to not panic and not focus on these short term disruptions, because long term, if I'm doing my job, which is saving the money, putting it where it needs to be, then the market over the long term historically is a growing piece of the overall economy. And so if I trust that even though there's short-term disruptions, that in the long run, the market's going to grow my investments, then I just have to sit through it. Don't panic, focus long-term, and do my job, which is continue to save. So like we've talked about before, when the markets are down, if I'm putting $10 in, I'm buying more shares because they're cheaper. And so continue to add that money despite what the market's doing, or because of it, add some more if you have the extra cash. And then focus on what you're invested in. There was a reason why you bought it to begin with. You don't need to panic and change out. If fundamentally things have not changed for your long term, you don't need to be micromanaging those little investments.
Mm-hmm.
Yeah. I have a client who checked in yesterday and said that he hasn't opened his app in 3 months.
Yeah.
Like, good for you, man.
Absolutely.
Yeah. So
if you know it's going to cause some stress, just avoid it. If
don't
you
look.
don't need to look.
Just don't look. Something bad's happening, don't look at it.
And if you have a long enough time horizon, a correction, so we're down like 10%, right? A correction's not a bear market. Bear markets can be very drug out in terms of how long. In fact, 31-ish months is kind of how long it takes for a bear market to correct back to get back to all-time highs after going down 20. But it's usually 3-4 months, less than a year even, when a 10% correction gets back to all-time highs. So if your time horizon is more than a year or so, you're probably going to be just fine, and it's not worth getting too freaked out about. Now, this may have a short-term impact if you're planning on retiring in the next month or two, but not if you're planning. If your time horizon is more than a year or two.
Even that, because I remind retirees all the time, not all your assets are needed in that first year of retirement. So that's the other piece of this is even retirees, you need to have a long-term horizon for that growth to counter inflation. And so you only need to be cautious. We talk about, protecting against those bear markets by having some very conservative cash or some sort of very conservative investment to protect those short term. But that's it. Everything else should be geared towards fighting inflation, because that's your biggest component to hurt your financial success is the growth of purchasing. Right? It costs more. My purchasing power has to grow to keep up with how much, eggs are $160 a dozen or whatever they are right now. The cost just keeps going up, and I need my money to grow so that I can still afford the same things I did last year, but I need more money to do that.
Yeah.
So that's the thing to always keep in mind. I need to have a bucket for the short-term volatility if I'm drawing money out, but I also need a bucket for long-term growth to counter that inflation for my year 20, 30 years from now.
Yeah, I also think if you're a retiree and you're taking distributions from your portfolio, and maybe this this market correction has sort of increased your anxiety levels about what your risk tolerance actually is, it's a great conversation to have with an advisor, because when we're in a bull market like we've experienced the last 2 years, I mean, we have 2 consecutive years of 20+% returns, right? It's very easy to be bullish, to have a higher risk tolerance when stocks are performing in that way. However, when you have that first bull or that first bear market or that first correction, you can find out very quickly what your real risk tolerance is. Certainly, you don't want to make any significant changes when stocks are down. You want to allow them time to recover before you make any big changes. But that's definitely a conversation you should be having with your advisor.
Yep. Yeah. So as we kind of wrap up, market corrections, that's normal. There's nothing unusual, nothing unusual about it, because the markets have to periodically readjust, get back to a more realistic expectation. Tariffs, that's also normal in the sense that we've had tariffs at different levels throughout the history of the United States. But right now we're just experiencing a little bit of a bumpy ride as there are adjustments for the market and the economy to kind of digest what's happening.
Mm-hmm.
And then the last one is, don't panic.
Don't panic.
Stay calm. Look forward. Make sure that you have that long-term goal set to know where you're going, and it will help the short-term stuff kind of fade to the side, because that's not what you're focused on. You're looking farther down the road.
I think, as Chase pointed out, this is not the time to make a rash decision that could ultimately negatively impact your long-term picture. So just keep a long-term time horizon there. Don't let a short-term paper loss, maybe your portfolio is down 10% on paper right now, well, don't turn it into a permanent loss where you actually take that and turn it into cash and lock it in. Let those investments recover over time, and they will. They always have. Past performance is no guarantee of future results, but we do know the markets heal over time, and sometimes it takes time.
The loss is not real until you sell.
So the only risk you should be taking right now is how your bracket is playing out, right?
Yeah, that's right.
Don't go all number one seeds, right?
Don't go all number one seeds, or take Clemson to win it all and get out in the first round.
Yeah, like our colleague did.
Yep, that's right. Well, thank you for listening today. Hopefully this discussion provided some value to you and can let you rest a little bit and sleep at night in the current correction that we're in right now. Don't forget to subscribe to the show on whatever platform you're on so you don't miss an episode. Also, visit us at thewealthmindsetshow.com for more resources. And if you're ready to invest with us, head over to hzcapital.com. Check us out. Check out who we are.
Can we check us out?
Check us out 3 times. Check out who we are. And if you're looking for an advisor, we'd love to give you a second opinion. Check out the Invest With Us tab there. And we'd also invite you to follow us on all our social medias. We're pretty active there, and we'd love to catch up. Until next episode, have a good one.
Talk to you later.
Thanks. Bye.
Thanks. Bye.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hixon Zuercher Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hixon Zuercher Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hixon Zuercher Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.